Welcome to the UTI Swatantra series powered by ET Now. This series is an investor education initiative between UTI and ET Now. The idea is to break down everything complex in the world of investments and give you the simple ideas that you can use to get rich over the long term. Remember, our idea of long term here is 10 or 20 years. If you have any questions for us, if you'd like to join us in the studio in the future, go to our website, indiainvestguru.com, and log in. Leave us your question or tell us you'd like to be part of the show in the future, and it'll be our pleasure to have you here in the studio with us. You can also tweet out a question, #InvestGuru, and we'll try and answer your questions on the show. Now, this week's show is about working professionals who want to plan for their children. So we've tried and brought in as many people as we could into the studio to ask us questions, but we also have two wonderful gentlemen who have joined me in the studio to answer those questions. I'm going to do a quick round of introductions. Abhinav Angarish is the Managing Director of InvestOnline.in. And Siddhartha Dash is the Country Head of PSU Clients at UTI Mutual Fund. Gentlemen, thank you for coming in. I want to start by asking you, Abhinav, we'll start by talking about this. The market is full of child-focused investments. A lot of times we pick up a plan because it says child plan, or it says smart child, or it says, whatever. There's always child in the name. Is it necessary that all planning for children has to happen through a child plan, or can I just do it myself, perhaps using maybe an equity mutual fund?
Absolutely. So if you actually look at all these child plans and you get into the depth of it, they are pure equity funds or balanced funds per se. So I'm not saying that the asset management companies are misguiding investors, but the point being, as an investor, it's easier for you to relate to the term, right? So whether you pick up a child plan or you pick up a balanced fund or an equity fund per se in the same category, you'll probably have similar returns. There are many times where even the fund managers are same. So going by only the theory, the thinking that these are specifically child-oriented plans, it's not necessarily very important. So whether it goes to insurance or funds, or even bank deposits, now you have various banks selling the child fixed deposit per se, but the returns are same, right? So it's not that you'll get better returns if you have a child. So the concept is similar.
Well, Siddharth, come in here and tell us this. There are various ways, like I've just pointed out, to invest for a child. I can use a fixed deposit, I can use an insurance plan, I can use a mutual fund. In your opinion, what is the most efficient way to do so? If I was starting today to invest for the next 15 years, what would be the most efficient way to do so?
Investment is a habit that one has to develop over a period of time and be regular and systematic on your investments. One has to always plan for the future. One has to plan what would be the future expenses, for example, buying a house, education, higher education for children, marriage, etc. So once you plan out your future financial requirements, then you need to sit down and start planning. The planning process has to be extremely systematic, it has to be regular, and all the asset classes that you mentioned, whether it's a fixed deposit or an equity or even a mutual fund, has to find part of, has to be part of your overall planning, financial planning, and has to be part of your portfolio. I would also include gold in that. So you have to make a mix and match for all these asset classes in your portfolio to get the best out of it over a long period of time, over a 15-year horizon. So investment, two things. One is always you need to be systematic, disciplined, and look at the long term. So that's the basic thing, and you need to have all the asset classes in your investment portfolio.
Well, Abhinav, there are child plans that combine insurance and investment, but I want to separate all of that and go down to the absolute basic. If I do have a child, which means I have someone who depends on my salary, how important is it for me to have life insurance?
So the two ways of looking at it. When you say child insurance, what generally we see investors doing is they actually go and insure the child, which doesn't make any sense. So like you mentioned, if the applicant is the earning member and he or she has a child, it's very essential to naturally know and to provide for the child when the applicant is not around. Unfortunately, what happens in our country, is people look at insurance more from an investment perspective. I would say it is not an investment at all, right? So I would just say use insurance just the way the term defines it. It's cover of risk. and it is nothing beyond covering that. So it's just like covering your house, your factory, your car, or anything that you like. It's just covering that. Life should be treated more important than all these things. So please insure life more than that. Here, we are more interested to know when we would get our money back for the premiums that we've paid, so on and so forth. No one really thinks that we're doing insurance for a purpose that when the applicant or the main earning member is not around, the child should get the benefit of it. Also, planning, like even Siddharth just mentioned, it's the very important point is that we try to plan everything in life, whether it's vacations, whether it's a meal, whether it's dinner tomorrow or breakfast on Sunday, and so on and so forth. But we just don't want to plan investments, which is a big problem. But I think also the reason being is it's a very long-term planning. You're planning for almost 15, 20 years, and it's a very long horizon to have. But I think it's important for, as a family to sit down and figure that what are our, expected needs coming in the near future or in the long term. So there are very fixed needs, right? So right from, childbirth, from getting married to childbirth and to educating and marriage and retirement and so on. So I think it's very essential to mix all these things together, make a goal, plan it, mixing investments, mixing insurance, and multiple other asset classes you can. So I think, it is, your first question, it is very important for the applicant to get insured with adding other products to it as well.
Yes, please go ahead.
My question to you, how mutual funds play crucial role to achieve the financial goal of anyone investor? Like I have three major goals. One, I have loan liability of around 5 lakhs, not a myth. I have a daughter, age is 10 years, still 10 years to complete his graduation. And she want to be a fashion designer. Because I have to inflated, adjusted, corpus required for that purpose. Apart that one, still 15 years in my hand to retire. So can you tell me how the mutual fund can play the crucial role to achieve all my financial goals?
Mutual fund would be one of the assets that will take care of your future financial requirements. It will be an important asset because mutual funds provide the diversity of risk. Your risk gets diversified across a lot of portfolios. That is one. It gives you professional fund management expertise to balance your to manage your funds. So that to that extent, mutual fund, and it allows you to participate in the capital markets in a much more risk diversified manner. So that's the advantage of investing in mutual funds. Also, mutual funds provide an opportunity, a product called the systematic investment plan, which with regular investments every month, disciplined investments every month, the corpus keeps on growing, and according to the markets, the portfolio also keeps on changing. Now, apart from mutual funds also, there are other asset classes which you should, as I said, you should not put all your eggs in one basket. Mutual fund is one important part of your asset allocation, but then you need to look at other assets as well. As I mentioned, gold is there, FD is there. So all these products are also as important.
It's how we advise our investors. So when you have a loan, I think first you should really plan to close out that loan so you start having a corpus. Like Siddharth mentioned, we're talking about systematic investment plan. If you just see the power of compounding it does. So an investment of 10,000, if you invest today for the next 15 years, it gives you corpus roughly anywhere from 1.2 to 1.3 lakhs at an average return of 15%. In just an additional 5 years period, from 15 to 20 years, that 1.2 crores actually becomes 3.5 crores. An additional 5 years becomes 7.5 crores. So power of compounding is very essential. So basically what you do is when you're creating your plan, your goals, you actually segregate your baskets to know how much money you'll need when. And when that corpus becomes larger, about a year or so earlier, you actually start moving to the debt side of the mutual fund, which gives you an option to do all this, which you'll not get in other products. And you can keep that money stays and grows very gradually so that eventually when you need the money to withdraw, it's there and it's not going to be dependent on the markets then. So your first question, mutual funds, I think is one of the best routes you can use today to actually make all these portfolios, because systematic investment plus professional management and flexibility to invest and with liquidity as well, how many options do you have? So I think it's a great time that we have these kind of products available to us today.
All right, so mutual funds is a good way to go, but we'll come back and we'll talk more about how to pick out a mutual fund. We have to take a very quick break. Remember, you can send in your question, #InvestKaro. It'll be our pleasure to answer your questions on the show. Stay with us on the other side. Welcome back. You're watching the UTI Swatantra series on ET Now. Thank you so much for staying with us. We're talking to young working professionals about investing their money. We have a question from the back. Go ahead.
Yeah, hi. If you look at the past, silver has grown proportionately at a very fast pace compared to gold. So my question to you is there any product there in the market like a mutual fund or any other product that is there, asset product, which would have grown in the same fashion or which we could look up to in the future?
See, again, I don't think there's any silver ETF available in the market right now, but there's definitely gold. See, what happens really is we tend to focus more on the past returns of any asset class, right? So if you've seen silver grown, so I think silver has dramatically fallen in the last 2 or 3 years. From 65,000 high year today, I'm trading at a low of 28, 30,000 if I'm not wrong, right? So you've practically fallen more than what you're actually invested. The point being, is silver really an asset class where you want to be in, right? So if you go back a few decades back where silver, which is actually more of a commercial commodity being used by industries, why really the demand was there. But now since it's tradable, you see that exponential growth happening. The gold is a real asset to have. Gold can actually hedge inflation. That's why we always recommend to people have 5 to 8% invested in gold. The point where you are asking me is whether you have any asset class or a commodity which will grow that much. Let's presume you have silver as an ETF. It's grown 50% this year. Next year it falls 20%. Then you'll again go back and look at another asset to buy. So it can't work like that. That's why it's very essential you create an allocation first, at where you want to park, how much money you should have in equity today, how much you'll have in debt, how much you'll have in a gold. Gold is also important, though it's fallen, but it's very important to have, or how much you'll have in real estate and so on. So that's very important to have, and then you focus on the other investments. You can probably have 5% of your corpus playing on such asset classes which can probably give you growth because of maybe an economic change or something happening all over the world, right? But you can't focus on that as your main investment.
Siddharth, I want to bring you in, and since so many, gold comes up so many times when we're talking about investments, and there are different types of gold funds as well. Just to take the level of complication up to one notch more, there are gold ETFs, there are gold funds, there are gold mining funds. If I were to simply, like most viewers and most investors, put money aside every month for a goal that's, say, 15, 20 years away. Maybe I have a young daughter who's going to get married and I want to save for that wedding. Among all of these options, what would be the most efficient way to do it?
Well, as you rightly mentioned, investing in gold currently has a lot of options. You have a brilliant gold investment product called the ETF, wherein you invest the value of gold, current value of gold, you get units of ETF on that, and at the time of redemption, you get the full value of at the prices prevailing at that point in time. Now, the advantages of investing in ETF is that one, you don't run the risk of storing physical gold. You do not have the risk of storing physical gold, and second, you get 100% of the value of the gold when you redeem. Generally, what happens if you have physical gold, there is some deduction when you go and sort of redeem it in the market and get cash back. So these are the two big advantages, which requires a little bit of breaking the barrier, so to say, because traditionally we want to have something which is more tangible, especially gold. So it requires a little bit of breaking the barrier, but it's a brilliant product to invest over a period of time. Buy units of ETF. You are risk free in terms of storage as well as the value that you get.
Yeah, hi. I just wanted to ask one thing. The markets have been fluctuating all around. Okay, so when my kid is there, and sometimes I feel that instead of investing in mutual funds, it is better to invest in some government funds like PPF or a post-bank saving account. So how do you advise how much percentage should go into something which is a fixed return asset and something like a mutual fund or equity linked plan?
I'm going to, take the question, and this is a question a lot of people have, take it one step further, which is basically you feel that since the goal is so important that I'm putting money aside for my child or for my retirement, it's completely non-negotiable. I don't want to take any risk at all with that money, and you put it then in something that's entirely fixed income. What is the larger risk of inflation that happens then when I take something that's entirely fixed income?
Well, if you look at PPF as an asset class, as Abhinav earlier mentioned, it's a brilliant example where the power of compounding comes into play. If you look at a 15-year and then the next 5 years and the next 5 years, it just multiplies phenomenally. And then since you have locked in that amount of money, it's the first principle of investment. Look at it for a long term is taken care of forcibly if you say so. So yes, that is one of the products that one needs to have, and then you need to balance it with, when there's a kid and you're planning investments for the kid, the life stage analysis of investment comes into play. As you are younger, you can tend to take more risks and get into slightly riskier asset classes like equities. As you grow up, your risk appetite comes down and you shift to lower risk assets like FDs and debt schemes. So percentage of equity investments will always be higher when you are younger. It will come down over a period of time. So while investing in equities at a younger stage is good, PPF is also an equally good asset class to invest in, because the power of compounding again gives you that additional return when the 15-year, 20-year period comes closer. So it has to be a balance between the two. You have to make a balance between the two investments.
I think essentially when you mention life stage, what really happens is when we go from when the child is born, the first 3 years, then the 3 years later, it goes into education, then it goes into higher education, then it goes into marriage and so on. So once you benchmark, the amount you need is only when you can take a call on doing it. So if you're saying it that I need some money for the next 3 years, will be into different asset class, right? And you need money for the next 10 years, will probably be in equity. But if it's you need something in the next 6 months, it'll probably be into pure debt or liquid kind of situation, where you can take either short-term FDs and so on. When talking about PPF, talking about 15 years period, right? And if you're investing early in life, which we always recommend, say like 25, 30, 35 kind of age, you can invest for like 15, 20 years. So when you know that an equity can give returns, you should invest into equity. You can look at the higher like IRR returns. Of course, so you will again benchmark and say, I'm going to put X amount into equity, I'm going to put some amount into PPF as well, and so on and so forth. Now today you also have options, like earlier we used to use PPF only for tax savings. Today you have options in equity which also give you tax saving. You have an option to invest into equity on a monthly basis and yet get tax saving by investing as low as 500 rupees. So why not use these long-term papers when you have the option to to do so? So I think that's something you should look at.
All right, we're going to take a very quick break, but when we come back, we'll continue to talk more about how you should be investing your money to get rich over the long term. Don't go anywhere. Welcome back. You're watching the UTI Mutual Funds Swatantra series on ET now. Thank you so much for staying with us. We're talking about investing your money. I want ideas from both of our guests at this point. So for young people or people in the middle of their careers right now who suddenly sit up and realize that other than the mandatory PF deduction, that they haven't made any sort of retirement plan up till now. And if you're watching at home and you haven't made a retirement plan, it's already too late, irrespective of how old you are. You have to start doing it right now. What should we do? Because the tendency again is to, do a PPF. And my personal opinion is to stay away from the PPF if you already have the PF. What are the other options available in the market right now for a retirement plan if I'm either at the beginning of my career or mid-career right now? Siddharth?
Well, retirement plans are now available in the market. The NPS is available in the market for salaried people. Mutual funds also have retirement benefit plans that are there, wherein you gradually build up a corpus. The corpus essentially gets divided into equity and debt, and as it keeps on growing, as you reach a certain age, the rebalancing comes in, percentage of debt goes up, and then you get a monthly income depending on the corpus that is generated over a period of time, which helps you post your retirement. So a retirement corpus is built up and then you get monthly income. So that is something which is essentially very, very important in today's financial planning, because retirement, a lot of people who are currently working are going to retire in the future, and retirement is also a big thrust of the government by launching NPS and all that. So it is something that is available in the market, and I think most of us should plan pretty well about it.
What's your advice for someone who doesn't have a retirement plan?
See, so it can actually vary between when you're starting, right? So like you mentioned, someone who's just starting, even he should make his retirement plan well in advance. So I would say I would not recommend PPF at all.
Yeah.
I would say if you're investing money for 15 years and probably even take the 5-year extension, 20-year investment, please be into equity. Right, and as Siddharth mentioned, once you move forward, say you're in your mid-career period and so on, so you should look at balanced funds is what I would recommend. So even if you look at the NPS per se, NPS is an option which is more of balanced more than anything else.
It's technically a balanced fund.
It's actually a balanced fund. So though not so great returns as of now, so you naturally look at more professional and well-managed funds per se. So I would say if that is the period looking at, and if you're benchmarking to the PPF, I think moving with age instead of equity, just move to balance. And I think that would do a far better bet than being into a PPF, which I call as dumb instruments. So they are. So I can't do anything about that.
All right, very quickly, I want to understand, Siddhartha, if I'm going to look at a balanced fund and take his advice, how do I choose a balanced fund in the market right now?
It is essentially the portfolio that one has to look into, the percentage of equity that one has, the percentage of debt that one has, and take a considered view of the returns that are being generated over a period of time, and invest accordingly. You need to look at various balanced products which are available in the market, make your own judgment about the portfolio quality, and then take a decision on how to invest and how much to invest in a balanced scheme.
All right. I also want to very quickly get ideas from you about health insurance. It's something that a lot of us overlook. And I personally believe that there's a massive risk with overlooking health insurance, because then I'll go out and I'll break whatever investments I have made and use it to pay the hospital bill because I've not got a health insurance policy. So ideally, if I'm living in any of India's metros, a family of 3 or a family of 4, what should my health insurance coverage be?
Okay, so see, like you first mentioned, I think we look at health insurance. It's completely neglected again because it's an expense. You don't get the money back. So no one interested in doing it. Only just covering yourself to the extent of the tax benefit you get, which is 15,000. The point being, like you mentioned, also being in metros, a family of 3, I think it all depends on age. But I personally feel you should take as much of coverage as you can, because you're actually locking your premiums from today going forward as well. So I would say if you can afford to take as much of cover you can, ranging from 5 lakhs to 25 lakhs are the range. You even have 50 lakh and 1 crore covers now. But I'm saying if you want to go to a good hospital, get some, good doctors to look after you and some good services and so on, you will have to spend. And it's a crazy amount of money which goes into actually in like today's healthcare. So I think you should take as much as you can. I think minimum 5 lakhs is what you would need individually per person in the family. And it's not as expensive as it's perceived to be.
And there's the added benefit of a tax deduction
absolutely
as well.
True.
How important? Yeah, you want to
taking off from where, health also is going to increase in terms of the costs. Inflation. So, the higher the health cover that you take right now is going to hold you in good stead in the future. So that's also something that one needs to keep in mind.
Right, and we have a basic thumb rule, and we talked about this. Health insurance you absolutely must have. There's no negotiation there. Life insurance, if you have a dependent, you absolutely must have.
So a term plan, rather.
Yeah, a term plan, absolutely. And the best way to do life insurance is to simply buy a term plan. Both of these things are already tax deductible. They will take care of a certain amount of tax deduction that you need, after which, like Abhinav said, an ELSS is really the most efficient way to go in our market right now. Siddhartha, if I were to choose an ELSS, there are aggressive funds, there are funds that are slightly more conservative in their asset allocation. How do I pick out of the entire gamut that's available to me?
You have to look at you have to have a view on the markets for that. If you are looking at a cycle which is warming up to the equities, then probably an aggressive bet on ELSS schemes would be more prudent. Or if you are looking that the markets are, because it's a 3-year horizon, it's a 3-year product or a 3 to 5 year product. So you need to look at how the markets are going to work. But historically, as Abhinav said, 3-year, 5-year, 10-year returns in equity ELSS have been very good. Coupled with the tax advantage, the returns become very lucrative. So I think an aggressive bet when the markets are doing well is. Do
you agree?
The logic of 3 years, 5 years, 10 years definitely in.
Yes.
The point being, I said, why do we need to time it? Right? So if you want to get in today, I mean, if which we are at an all-time high, so I should not buy an ELSS today because it's at all-time high. We can time it. That's not what we want to do with mutual funds per se, being professionally managed. I think we should go ahead. The point is, it is not 3 years. It can stay for 10 years as well. It's not that your money is going to come out like a PPF, either renew it or take it back. So it can stay. And why restrict to like $1.5 lakh? I would say, I mean, if it is an equity product, I would actually say ELSS has better benefits than a regular diversified. Because a fund manager knows the money is going to stay with him for 3 years. Yes. He can take a better call. And generally, all ELSS funds are aggressive.
All right, unfortunately, that's a wrap on the show this week. Thank you so much for watching. Remember, you can get in touch with us if you'd like to. Log on to our website and leave a question. or you can tweet out your question, #InvestKaro. Gentlemen, thank you so much for spending time with us. Thank you for watching.
Brought to you by UTI Mutual Fund. हक एक बेहतर जिंदगी का.
Mutual fund investments are subject to market risks. Read all the scheme-related documents carefully.